Welcome to this episode of PhillipCapital's Market Watch. I'm Glenn Thum, Research Manager from Phillip Securities Research. Today I'll be sharing insights into Singapore's banking sector and how the banks are doubling down on capital returns. Let's begin. The three Singapore banks, DBS, OCBC, and UOB, recently released their first quarter results at the start of May. All three of them had relatively similar results, with the key highlights of lower net interest margins, higher fee income, higher trading income, and higher allowances. Net profits were down slightly, as excess earnings were placed into general provisions due to the current macroeconomic uncertainty. Notably, all three banks have reiterated their commitment to the capital return initiatives announced last year. We are forecasting a dividend yield of approximately 6.6% for FY25. Next, we will look at loan growth in Singapore from the data provided by MAS. Loan growth has a direct impact on the direction of net interest income's growth, which makes up the majority of the bank's revenue. Loan growth has recovered steadily and has been at around the mid-single digit for the last 4 months. This was mainly due to the rate cuts which kicked in, making loans more attractive for consumers and companies. Manufacturing loans saw the strongest recovery, while building and construction and housing loans remain stable. We expect loan growth to come in at mid-single digit range for FY25, though it could face headwinds from the trade war, which would reduce consumer demand. Despite the lackluster earnings this quarter, the banks have doubled down on their capital return initiatives, and shareholders can rejoice. Dividends are expected to increase by 27% year-on-year, and the dividend payout ratio in FY25 is expected to jump by 10 percentage points. We believe that the banks will continue to pay out what they have promised, as these returns are coming from excess capital that was already set aside. Shareholders need not worry that external factors such as the macroeconomic uncertainty or the trade war will cause a U-turn in the bank's decision to continue with this initiative. Furthermore, sufficient allowances have been set aside since the pandemic era, which will provide enough coverage in the event of an unlikely provisioning cycle. A common question I get asked is, are the banks too expensive to buy? Investors commonly look at the price-to-book ratio of a bank to gauge if it is overvalued or undervalued. While I agree that the price-to-book ratio is a useful measure for banks, it should not be the only ratio used. In this case, we'll use two ratios, price-to-book and return on equity. Indeed, the price-to-book has risen by almost 40% since the pandemic era, but the return on equity has increased at a similar pace. We believe that a high return on equity, supported by stable earnings and a reduction in excess capitals, will improve valuations. Next up, I'll share some key investment merits for the three local banks and why we like each of them. Starting with DBS, we expect earnings to remain flat this year as higher taxes from the global minimum tax will affect their bottom line. We like DBS for their clear and fixed dividend policy and the highest dividend payout ratio as compared to their peers. DBS is our top pick among the three banks, as they are the only Singapore bank with a fixed dividend per share of $3.06, while OCBC and UOB maintain floating or semi-floating dividend policies. DBS has also mentioned that they are comfortable to go above a 50 to 60% payout ratio if earnings come in lower than expected. We maintain and accumulate with a target price of $44.50 for DBS. Moving on to OCBC, we expect a more subdued FY25 earnings growth of approximately 3%, as higher fees and trading income, lower net interest margins, and higher expenses and allowances will offset loan growth recovery. We like OCBC as they have the highest excess capital amongst the three banks. FY24's fully phased-in CET1 stood at 15.3% and represents excess capital of approximately $3.4 billion, which is the highest amongst the three banks. While the capital distribution is expected to lower CET1 to 14.3%, we believe this special capital return dividend can continue for 2 more years in order for OCBC to reach their optimal ratio of 14%. We maintain and accumulate with a target price of $17.10 for OCBC. Last but not least, we have UOB. We expect UOB's FY25 earnings to remain flat year-on-year as excess profits will be placed into general provisions to strengthen their provision cover. We like UOB as the Citi acquisitions have accelerated their plans to shift away from net interest income into non-interest income. UOB has successfully integrated the Citi portfolios in all 4 countries, Malaysia, Indonesia, Thailand, and Vietnam. This could expand its regional franchise with a larger deposit and customer base. We expect fee income growth of approximately 16% for FY25, which could add around $380 million to revenue. We maintain and accumulate with a target price of $35.50 for UOB. With that, I hope that the trading insights shared today will be beneficial for your investment journey. If you have any questions regarding the Singapore banking sector or other stocks we cover, feel free to reach out to the research team or to me. That's all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on our social media platforms and subscribe to us on YouTube. Thanks for joining us and see you next time.